Busy morning indeed. As we mentioned at the top of the hour, we've got a steady number of Canadian banks continuing to report quarterly results, and it looks like a very robust trading environment has been beneficial to the Canadian banks. Of course, they'll have to navigate all these tariff headlines that we're literally hearing about again this morning. Let's bring in Dan Rohinton. He's a portfolio manager at IA Global Asset Management to get his assessment on what is happening within the financial services sector. Dan, thanks very much for joining us. Let's start with the fact that you've got three big banks, Royal, CIBC, TD, out with their quarterly results today. What was the big takeaway for you?
I think broadly speaking, it's a continuation of what we've seen across Scotia and BMO as well. So capital markets being very robust, wealth management being generally quite good, and Canadian P&C coming in better. And I think it's very important to really zero in on the provision for credit losses, the gross impaired loans. We saw it in terms of a precautionary way in terms of what the companies are putting forward. So think of the RBC with talking about one big commercial loan that they're looking to get a hold of because of the tariff situation. But the Canadian consumer did not crack this quarter, and that is very critical in my mind.
So do you feel as an investor like these results give you confidence in investing in Canadian banks?
It gives me, I'll give you a slightly different answer to that question. It gives me confidence that the valuations, although they are on the higher end, are unlikely to materially derate on the back of this unless the tariff threat continues to really get pushed through and we start seeing it in a depressing of consumer sentiment and business sentiment. So I think this is more neutral and telling you that the waters are still calm, although there may be some choppier seas ahead for us.
Yeah, well, I was citing some data from Bloomberg Intelligence earlier where they looked at stocks on the Canadian stock market that involve physically moving product from Canada to the United States. And just because of the makeup of our market, there's actually a large percentage that wouldn't technically fall into that bucket. And even the banks themselves, while they are working with clients that are navigating that, and there's headline risk, I guess my question is, how do you feel about investing in the Canadian stock market amidst this tariff threat?
I think you have to be very specific where you go. I think the property and casualty sector within financials is a oasis of calm and durability. I think the life insurance sector as a whole within financials has really come into its own. We've got buybacks, we've got dividend growth, we've got improvements in core earnings across the board. And for the banks, which don't directly get exposed but are a broad representation of the Canadian economy, it's okay for now, but it is likely to get a little bit more choppy as we look ahead. And they really set the table for that this quarter because all the banks, and I'll zero in on RBC because the conference call just ended. Yeah. They did talk about adverse scenarios and just starting to price in that in terms of loan losses that are coming through. So when you're looking at the TSX, really peel the onion one layer back and know that utilities are an oasis of safety, grocers are pretty solid, life cos are good, P&C is good, and some of the other areas, it's a bit more of a mixed bag.
And would you be, at this point, I think whether we actually see the tariffs or not, what we keep hearing from economists is the back and forth on it just creates uncertainty. So are you starting to work more weakness for the Canadian economy itself into your projections for the year?
Yes, because to exactly your point, the ever-present threat of something happening, even if nothing eventually happens, does dampen business activity, and our economy sentiment does matter. So animal spirits and where they go does have a role to play. But I do want to take a zoom back and say, I think it's very important the trajectory of housing in the next 12 to 24 months is going to have a big role to play in the Canadian banks and how their credit quality does ultimately go. And I keep zeroing back on that point, and the reason for it is the Canadian banks as a whole, the revenue side, it doesn't move around that much outside of capital markets like we saw this quarter. Expenses, they do have some levers to pull here and there. The part that you can't outrun is credit migration. to the positive and to the negative. So keep a close eye on housing as a broad barometer of how loan credit quality is going to go, which will have a disproportionate role to play for the Canadian banks' earnings.
And is it wrong for me to assume that if like all signs are pointing to lower interest rates in Canada, that actually doesn't help the housing market and maybe kind of keeps some sort of creates a positive for the banks indirectly? Not to confuse matters even more here, but.
Yeah, I would dissect your point into the net interest income side, which I don't think is particularly, the banks are reasonably matched on this, so it's not that big of a driver. It's directionally a little bit negative on revenue, but really the heart of where you're getting at is actually, do rate cuts help give a sigh of relief to homeowners that are a little bit strapped on cash flow? And I tell you impulsively, absolutely that's the case. But at the same time, why is the Bank of Canada cutting rates? It's probably because there's economic weakness, the potential for unemployment. And I tell our friends in the audience that ultimately credit quality is directly linked to unemployment. And that is also what the Bank of Canada is watching. So that is really the core linchpin of this conversation.
Yeah, I guess so. Well, I guess we'll find out what happens to the economy, what happens to the housing market. Now, in terms of the fact that one of the big takeaways for these bank earnings is that the trading markets have been alive and well. I mean, everybody who's watching BNN Bloomberg knows what's been going on. Do you think that we stay? I asked a guest this morning if in the U.S. if he felt the bull market was intact, and his quick answer was yes. Do you think, even with all these uncertainties, that we remain in a North American bull market for stocks?
I think generally speaking, yes, although it's important to really take stock of where we've come for the last 2 years. So don't expect the bull market of the last basically 2023, 2024, which was really coming off of a denominator low in 2022. So I am constructive on equities, but we are a bit more cautious than we were really last year and the year before that. So it's more measured, it's more reasonable, and it's more in line with what long-term returns bring. And it's important to appreciate that ultimately it comes down to the earnings picture and how earnings do go. And so far, so good this past earnings season across U.S. equities and Canadian equities. And it's really just a bit of a slower picture as we look forward, but no major red flags, I would say.
Okay. There's lots of unknowns, so I appreciate you fielding all those questions, Dan. Thanks very much, Dan Rohinton, Portfolio Manager, IA Global Asset Management.